Have you ever stopped to think about how people become millionaires, or wondered how they manage to earn money consistently without much effort? In this video, we'll uncover the strategies that successful millionaires use to build their wealth, and by the end, you'll be ready to start your own journey toward financial freedom. Imagine asking a group of people if they'd like to have $1 million in their bank account. Most would undoubtedly say yes. But as Morgan Russell explains in his book Financial Psychology, the appeal of being a millionaire often stems from imagining how to spend that money, not necessarily from wanting to manage it. This is an important distinction. Spending $1 million is the opposite of actually having $1 million. Before you can learn how to manage money effectively, you need to figure out how to earn it. So ask yourself, how many income streams do you currently have? If the answer is none or just one, it's time to diversify. Relying on a single source of income is risky and unstable. The more income streams you have, the more secure your financial footing will be. That's the first takeaway from this video. You need multiple income sources to strengthen your finances. If you're ready to dive deeper into the secrets of developing those income streams, stick around until the end. And if you're committed, leave a comment that says, "The secret is to have multiple income sources." When I see that comment, I'll know you're serious, and I'll make sure to like it. Now let's get into it. When you're starting out with no money to invest or without a clear plan in mind, your options are limited. You'll need to trade your time for money by working a job or offering freelance services. This is called active income. It's money earned through direct effort, whether physical or mental. However, if you're carrying overdue debts, it's vital to focus on paying them off first. Debts make it much harder to build a stable financial foundation because of accumulating interest, which can quickly spiral out of control. If you're dealing with multiple debts and can't pay them all at once, start by addressing the one with the highest interest rate. Reach out to your creditors to negotiate better terms. Many companies are willing to offer discounts or payment plans to help you get back on track. And most importantly, avoid taking on new unnecessary debts. This will help preserve your financial stability and free up resources for smarter money management. Once you've stabilized your finances and have a steady income, you can start exploring ways to generate passive income. This could include investments, starting a business, or creating a project that earns money over time. Passive income is money earned with little to no ongoing effort, but it's not something that happens overnight. Every source of passive income begins with upfront work or investment. For example, if you're working a regular job during the week, that's active income. But if you also have money coming in from an investment or side business, that's passive income. Building passive income requires effort at the start, whether through time, money, or both, but it pays off in the long run. Your ability to generate passive income will also depend on your personal investor profile. This profile determines your level of risk tolerance and helps pinpoint the types of investments that suit you best. By understanding your preferences and financial goals, you can make smarter decisions and choose strategies that align with your unique circumstances. With this knowledge, you'll be better equipped to grow your wealth and achieve your financial dreams. When examining investor profiles, we find three main categories, each offering unique approaches. First, the conservative. Investor prioritizes financial security above all else, even if it means accepting lower returns. This strategy emphasizes stability and focuses on preserving capital rather than chasing significant profits, making it ideal for those keen on minimizing risk. Next is the moderate investor, who values security but is open to calculated risks. This balanced approach seeks to enhance returns by carefully diversifying the portfolio with a mix of less and more volatile investments. This method allows flexibility in adapting to changing market conditions while maintaining a steady growth trajectory. Lastly, The aggressive investor strives for higher returns and is undeterred by greater risks, as long as those risks are measured and manageable. This profile embraces bold strategies and seeks out opportunities with significant growth potential, even if they come with increased volatility. By understanding these profiles, investors can align their financial goals with their personal risk appetite, helping them make informed decisions and build resilient portfolios that perform well in various market scenarios. On another note, there are two primary types of passive income: fixed income and variable income. Fixed income refers to investments with clearly defined rules and predictable returns. When you choose this option, you know upfront both the term and yield of your investment, making it an attractive choice for those who value stability and financial security. There are various fixed income options available to suit different needs. Variable income, by contrast, involves investments where returns depend on market performance and cannot be predicted at the outset. These investments are influenced by market dynamics and can lead to either significant profits or losses. While variable income carries more risk, it also offers the potential for higher returns, making it suitable for individuals willing to trade certainty for greater growth opportunities. Those who can handle uncertainty may find variable income a powerful strategy for achieving substantial financial gains. Understanding the distinction between fixed and variable income is crucial for building a diverse investment portfolio that balances risk and reward. Now that you're familiar with active and passive income, it's time to consider how to use the money you earn effectively. Managing your income is often more critical than earning it because money represents time. Every financial gain, whether from active work or passive investments, comes at the cost of time you've dedicated at some point in your life. For example, you may have sacrificed sleep to take on early shifts, missed social events to focus on studying, or spent weekends working instead of relaxing. Initially, earning money often requires exchanging your time, regardless of whether you're employed, running a business, or freelancing. After earning your income, spending it on unnecessary things essentially means wasting the time you worked so hard to invest. To improve your financial well-being, it's essential to shift your mindset from short-term gratification to long-term planning. This principle applies to all stages of life. If we constantly prioritize immediate pleasures, such as spending an entire paycheck on weekend outings, we risk falling into a cycle of dissatisfaction. Living for fleeting moments of joy while depleting your earnings during the week can lead to an endless loop of frustration where happiness feels out of reach Monday through Friday. Breaking this cycle involves thinking ahead, managing your finances wisely, and focusing on sustainable growth. Many individuals misuse credit by exceeding monthly limits and carrying debt into future months, creating even bigger financial setbacks. To avoid this, it's advisable to plan ahead financially and avoid spending your entire paycheck in one go. Rather than making purchases for short-term gratification, focus on long-term goals by putting your money into investments that can yield meaningful returns over time. Having steady income sources is key, but managing your finances effectively involves more than that. It's about boosting your earning potential and building an emergency fund. This basic principle can dramatically improve your financial well-being. It's not just about thinking like a consumer, but adopting the mindset of a producer. At first, this might seem strange, but it's an essential shift in perspective. Often, when we receive money, our instinct is to spend it immediately on goods or services. Rarely do we think about investing that money in ourselves, whether it's through learning new skills, improving at work, or pursuing personal projects. These are just a few examples, and you can tailor them to your own situation. The key takeaway is to use money strategically, not just for spending, but as a tool for personal and financial growth. The difference lies in cultivating a producer mentality. For instance, if someone receives $1,000, a producer considers how to maximize its potential to generate returns, while a consumer typically plans how to spend it. The goal should be to increase earning capacity, whether through financial investments or dedicating time to personal development, like studying for a new career opportunity. This approach not only helps you earn more, but also enables saving and reinvesting for a secure future. That doesn't mean you need to micromanage every dollar to save effectively. What truly matters is making intentional and informed decisions about your money. For example, while enjoying weekends is important, it's worth evaluating whether those funds could be better spent on something that offers greater long-term value. Striking a balance between enjoying life and prioritizing financial goals is crucial. As you start earning, consider setting aside a portion of your income to build an emergency fund. This will provide a safety net, ensuring financial stability and helping you avoid major setbacks in the future. Taking a step back to reflect on how you use your money is always a wise habit. It's not about giving up everything, but about being thoughtful and proactive with your financial decisions. Once you start earning, prioritize setting aside some savings to invest in your emergency fund. This foundation is essential for maintaining stability and avoiding future financial crises. If you've stayed with me until this point, congratulations on investing your time to learn strategies for growing your wealth. If this content resonates with you and you're committed to growing your financial resources, comment below with "I will expand my capital." Don't forget to subscribe and turn on notifications so you won't miss the next essential tips for financial success. Stick around until the end of this video to make the most of the time you've already invested. It's also crucial to start thinking seriously about retirement, especially if you've managed to get out of debt, have multiple income sources, and maintain a solid emergency fund. Few people reach this level of financial readiness, but it's important to assess how long you could sustain your current lifestyle without relying on work. A common measure of wealth frequently mentioned in personal finance is net worth, which is calculated by subtracting your debts from your total assets. For example, someone with a monthly expense of $3,000 and a reserve fund of $9,000 has enough resources to cover 3 months of living expenses while searching for alternative income sources. On the other hand, someone with $1 million invested, earning a 1% return per month and maintaining a $10,000 monthly lifestyle has reached financial independence. In this case, their investments generate enough income to cover their expenses without the need to work. However, it's important to remember that financial independence depends on maintaining a sustainable standard of living. Always evaluate your lifestyle and financial goals to ensure stability and long-term success. Spending more of your investment on large expenses can lead to financial setbacks. It's important to view money not just as a tool for spending, but as a resource for building wealth. Investing involves putting your money to work, allowing it to grow over time. By reinvesting your returns and taking advantage of compound interest, you can create a snowball effect where your earnings grow exponentially. However, this requires discipline, avoiding unnecessary expenditures and focusing on reinvestment. Instead of flaunting wealth through material items, prioritize improving your skills, generating consistent income, and allocating a portion of your earnings to investments. The first step is building an emergency fund and exploring strategies like investing in stocks or real estate funds to achieve financial independence. Financial literacy plays a vital role in this journey because investing is all about making your money generate passive income. An essential habit to adopt is the 90-day review rule. Every 3 months, assess your financial situation by noting down all your assets, including emergency funds and investments, and subtracting any debts. This helps track your progress over time and reminds you of where you started. Staying consistent, increasing your income streams, and committing to regular monthly investments are key to growing your wealth steadily. If you've made it this far, leave a comment saying, "I stayed until the end," ready to take your knowledge even further. This is the 4th video we've created on building wealth, and video 1 is now appearing on your screen. Click it and start watching. Wishing you success on your journey.